Getting a mortgage in Ireland isn't just about your salary. It's about the story that your bank statements tell, particularly over the most recent 6 months. Hi, I'm Cian, a CFA charter holder and qualified financial advisor. And in this video, I'll be walking through how to get your finances sorted, avoid any mistakes that could ruin your application, and to position yourself as a low-risk, ideal borrower. But before we jump in, subscribe so you don't miss out on any future videos. Section 1. What banks really look for. People assume that the first thing that banks look for is your income, but in fact that's not the case. Once your deposit is sorted, what they'll be looking for is your behaviour, and that's all shown in your bank statements. So key things that lenders look for is consistency of income, spending behaviour, evidence of savings, loan repayments if it's a previous mortgage, rent payments, and then also any potential red flags. Here's the thing: banks care about predictability. Someone earning, say, 100,000 a year is not much good to them if their bank statements are all over the place. They'd much rather lend to someone earning 70,000 a year who has demonstrated adequate saving, pays their bills on time, and exhibits good financial discipline. They're much more likely to get approved. For example, if you have a clean record and a 70,000 euro income, you could qualify for a loan to income exception where you could borrow up to 4.5 times your salary. So that's 70,000 by 4.5, that's 315,000 euros. But if you're earning 100,000 and your bank statements are all over the place, like I said, you might only get 3 times your salary. So that's 300,000 euro. And that's even if the banks approve you at all. So pro tip, take a close look at your statements. Identify unusual spending patterns, overdrafts, or inconsistent deposits. Try and catch these and address them before the bank calls them out. Section 2, bank statement red flags. Let's talk about what can actually kill your application. Top red flags, you probably have heard them before, but they include overdraft usage. Even dipping in €5 into your overdraft can be a red flag to the bank. Missed direct debits or standing orders. One missed payment might seem minor, but it's seen as a lack of discipline by the bank. It might not be a deal breaker, but it just avoids any unnecessary hassle. Online gambling. You've heard this before. If you want to gamble, do it with your cash, not online. Then credit card debt. Banks prefer zero balance over carrying any debt. Even if you pay it off, they prefer just a zero balance, so avoid using a credit card during the 6 months. Section 3, the 6-month cleanup plan. Step 1, ditch the cash. Cash leaves no paper trail. So before your 6-month review period, withdraw any cash that you think you might need for unexpected expenses. Then use your debit card, not credit card, just your debit card for any day-to-day spending during the 6 months. Banks are looking for consistent, traceable spending habits. If you're feeling a little bit daring, you can use some of the cash that you've put aside without the bank noticing. Step 2, pay off all loans. Make sure you clear all personal loans, credit union loans, credit cards, even car loans if you can, before the 6-month period. Even small debts reduce your approval amount and repayment capacity. No credit card use during this time. Think of it as cleaning your financial house before applying. Step 3, reduce spending noise. So fewer delivery orders, fewer subscriptions, fewer impulse purchases. It's about predictability during this time. Step 4, show the bank that you can handle repayments. If your future mortgage is expected to be, say, €1,500 per month, demonstrate that you can afford this amount. This can be shown either from rent payments or from savings or from previous mortgage. So your target is 1,500 a month. So say if your rent is 1,100 a month and you save 400 a month, there's 1,500. Or if your previous mortgage was, say, 1,000 a month and you're saving 500, there's your 1,500. So pro tip, keep a simple spreadsheet to track your income and your spending. We've covered this in the past, but it's important to have consistent patterns to show the bank. Step 5 is increase your monthly savings. Even if you increase it, say, 50 to €100 a month, this shows the bank again that you're demonstrating financial discipline, and they love that. Section 4, partner checks. Are you buying a property with a partner? Their financial history is just as important as yours. The banks will check. So it's important to make sure you're aligned and you understand for both parties any credit card balances, any mystery payments, any overdrafts, any gambling habits, or outstanding loans. Ensure both partners are in optimum financial condition before applying. Pro tip: just have an honest financial conversation with your partner. Do this early on so it can prevent any surprises when you're applying to the bank. Section 5: bonus tips and common mistakes. A few quick bonus tips now, which increase your chances even further. So keep the bank statements as clean as possible during this application phase. No sudden loans or big withdrawals. Avoid starting new credit cards and don't use credit cards during this time. Probably the third time I've mentioned that. So any gifts you get from your family, make sure you document that and tell the bank that if you're getting a loan from a family member to help with the deposit, make sure you disclose that. Start early. 6 months gives you time to fix and build strong repayment patterns. And that's it. They're the best tips to get yourself mortgage ready within 6 months. Follow this plan to present yourself to the bank as an ideal, low-risk borrower, and you should have success. If you want to get the highest approval amount possible, make sure to watch the next video, which will look at how to maximize your approval amount. In the meantime, make sure to like and subscribe so you don't miss any further updates from the Financial PT. Thanks for watching. See you in the next video. Bye-bye.